you've said that you end up talking founders out of taking money. And so I'm curious, what are some of the practical scenarios where that's the right call for a founder?
Well, I mean, think first of all, most founders, whether they're in the outside space or in general, I think are looking at taking money through the lens of venture capital. It's what they've seen on the news. It's what they've heard about. It's also, things like Shark Tank. Really, people watch Shark Tank. They think that's how it all is. I'll sell you 30% of my company for $4 million. And most outdoor businesses, when you really look at them, are not well suited to that. They're not the right, what I would call the right shape for venture capital. They just are a mismatch. But beyond that, I mean, one of the first things I look for is timing. Why are they raising money? What's their timing? What's prompting it? And usually if they're, 300,000 in revenue, they've got a couple wholesale accounts and they're like, oh, I got to hire a rep fleet and get everybody out there and really grow this thing. I usually will pull the thread and say, hey, tell me about your unit economics. Tell me about your return rate. Tell me the behavior of your customer over time. And, I get these blank looks. And, I would much rather, well, I guess what I tell people is what happens when you add fuel to that fire is you basically accelerate what's already going on, which usually you're not accelerating growth. You're accelerating whatever's broken in the business because they haven't figured out these fundamental things. The second thing is really when equity is the wrong instrument entirely. So I've had many, many people come to me and say, hey, we just got a $200,000 order from REI or $500,000 order from Target. We need to raise equity to be able to do this. And it's just fundamentally the wrong type of capital. And that's not an equity problem. That's a working capital problem. Now, it's still addressable. And, solving you kind of joke with people that solving a working capital problem with equity is kind of like taking a splinter out with a chainsaw, right? I mean, it gets the job done, but you don't want to deal with the damage it leaves behind. And, those are kind of the three scenarios that I see. And, part of it is maybe not talking them out of it, but having them push it back and doing a little bit of education around, what types of funding are out there, what's appropriate for what you're trying to do. Maybe even counseling them on, why don't you figure out these 5 things about your business and then let's talk again.
When you look at the early stage outdoor brands that you have these conversations with, what do you see that a typical investor, kind of from the VC Shark Tank model, typical investor, or even a bank loaning the money, what do you see that those capital partners wouldn't see in an outdoor brand?
I mean, almost across the board. I put all those in the institutional investor bucket or institutional capital bucket. A bank's going to look at and see a business that's inventory heavy, maybe seasonal. They have no real hard assets. It's a pretty easy no for them. Even if they're a community bank, I've seen, that kind of behavior, even where one of their stated goals is to promote, economic diversity and growth in the towns they're in. And on the investor side, kind of generalist investors are also looking at a lot of these things through the same lens. They see a small total addressable market. They see no real obvious path for a 10x return. And they're going to walk away. What I guess they both miss is that outdoor brands aren't really building products necessarily, building these communities, and the products are a part of that. And as part of that, the lifetime value of the customer, I would argue in the outdoor industry, far outstrips anything else. Once you've got a loyal customer, they're coming back to you again and again and again. You have a good experience with Big Agnes tents. You're likely to buy their sleeping pads. You're likely to buy their backpacks, et cetera, over a long time. And not only are you, a passionate user, you become an evangelist. And that's one of the sticky things that I like about this business, that you have a lot of repeat buying activities. And, I think one of the things that I tell people is, not every business needs to be a unicorn to be successful. You don't need to be $1 billion business. You could be a $3 million business, employ 6 people in the community, do good things, make a nice little return for you and for your investors. And, it just is a different animal than a software SaaS company that's going to, exit and a 100x multiple or something crazy, down the road. It's just how the nature of this business.
How much do you think that mindset of the founder coming into that conversation, that mindset of where they want this thing to go, or like how much of those conversations are about like, what are you optimizing for?
A lot of them, because I'll push back and ask exactly that. I mean, that is the exact question. What are you optimizing for? What do you want this to be when it grows up? An answer I often get in this business or in this category is, yeah, I want it to be a lifestyle business. I really like backpacking, so I'm going to start a backpacking company. And, I kind of joke with them, the old joke that the cobbler's kids have no shoes. It's like, if you want to backpack a lot, don't start a backpacking company, because you're going to find your backpacking less and less and less. Actually, I'm in the middle of writing a kind of a Substack about how to optimize for what you really want out of life. Because if it's, purely top line, then, and you may find that your goals and whatnot are mismatched to an investor. Now, the other one I get a lot is, I want a lifestyle business. I never want to sell it. And, that brings up another question, which is, listen, I'm somewhat altruistic. I do want to help educate you. I do want to help you get your business off the ground. But at the end of the day, I'm a capitalist and I need to find out where I'm getting a return down the road. It may not be as cut and dry as kind of a venture capital outlook, but we need to talk about whether that's a quarterly distributions when you get, to a certain scale, or, maybe down the road, you see folding this into a larger business or getting taken out by a competitor, and who knows. But, I always like to have that conversation. Like, what do you really want to be? I usually use that phrase, what do you want to be when you grow up, kind of thing.
Sure. It's a smart conversation to start at the beginning of every project.
Yeah.
Excuse me. And probably a good conversation to start at every relationship too. Is like, well, and we'll get to that because I always end with the same question. How do you define success for yourself? We'll get to that question. But I always think it's a wonderful question to start with.
Yeah.
And I know that this is probably a good place to state the obvious, that every one of these scenarios that we run into or you run into, every business is different. I mean, there's definitely universal truths across all of them. So I understand that when I ask some of these questions, they're not necessarily blanket responses that apply to every single one because they're unique. But what you just said brings up for me is like, here's the question of, can a lifestyle business, or should a lifestyle business, if that's their stated purpose, that's what they're optimizing for, should they even be having conversations about taking on investment?
I mean, yeah, but it's a different conversation. I mean, typically when you're in a lifestyle type of business, there's really a couple different ways to fund it. Almost everybody, I mean, if we've got to be honest, we're self-funding, we're pulling out of our 401ks, we're getting a second mortgage on our house. I mean, that is usually the capital stack that I see on day one looks a lot like that. I've got $20,000 of credit card debt. I pulled a second on my house. We've gotten this thing up to 800,000 in sales. I'm trying to figure out how to take it beyond that. And also, by the way, I'd really like to pay all that stuff back. So, I mean, self-funding is by far, the first, and then friends and family is right behind that. Right. And, I would extend that out into even the greater ecosystem in the outdoor space. I mean, there are a number of very successful folks in this space who've had a nice exit, who are quietly working in the background, funding companies that looked a lot like theirs did when they got started, in their 20s, and now they're in their 60s, 70s, and they are giving back to the industry in a number of ways. I would call that more patient money and also smart money. I mean, if you're starting a backpacking company and you get somebody who, built and exited from a backpack company over 20 years, you're getting not only the money, but you're getting a wealth of knowledge as well. And So I wouldn't say that you can't find money, but you're not going to go to the traditional, venture capital. You're not going to go to private equity route. They're going to want to know in 3 to 5 years, what's your plan for you to get me my money back? And not only that, but I want a nice return on that as well.
I think a lot of outdoor brands start with a passion, a vision for a new product, and probably a little bit of that lifestyle flavor
Uh-huh,
involved in it,
sure.
right? And so sometimes that's where the confusion comes is like we're not clear on what we're optimizing for because of the first two things are like passion, and then the third thing may end up being like, oh, I need rocket fuel.
Yeah.
How to make this thing grow?
Yeah, 100%. And that's, I tell people all the time, that's the best thing about this industry. I love it. I love when these people come in, just full of passion, hey, I've been a liver guide for 15 years and, now I've come up with this great new product that is going to solve for all these problems in the industry. And, they've done their homework. But oftentimes too, they don't have the basic business framework, that a lot of folks coming out of the business world would. And, part of, I think, our job as investors is to help them understand what they do and don't know and do a little education around, what is capital? What is equity? How does this all work? And, when I start to go into this, a lot of times people are a little embarrassed or, they don't want to kind of tip their hand, right, as to what they do and don't know. But having those conversations earlier are the best thing you can do. Just let's kind of set a baseline of who you are, where the business is, what you do and don't know, and let's help you fill in the gaps. Because if I believe in the entrepreneur and I believe in the product and the category, those are three big hurdles for me to jump over. The other stuff we can help figure out together, usually.
It's probably a good point to rewind a little bit and talk about how you first started investing in the outdoor industry. So I'm just curious what led to your first investment in the industry, and then what's kept you here.
I went to school at the University of Colorado at Boulder, a bit of a outdoor mecca. So was I climbed, I mountain biked, I did a lot of skiing, snowboarding, all the stuff, and was always enamored. Like a lot of us are, especially when I was younger, with the gear side of things. And so at CU, I actually worked for a company called North American Mountaineering that made climbing boards, ice axe boards to practice, et cetera. So I did that through a couple years of college. And although I kind of went off on a tech route for the next 15 or so years, always really maintained that passion around the industry. And in 2003, I had just finished a stint in London working for a software company, ended up back in the US and co-founded a small boutique private equity company called Basecamp Capital. And we had kind of the typical kind of a three-tiered approach to investing. And one of the areas we looked at was the outdoor industry. First investment we made in the outdoor industry was a company called Avid for Adventure that is still operating in Colorado today. The premier, I would say, day and summer camp for adventurous kids in Colorado. I was an investor in that deal, spent the next 10 years on the board. And then they had an exit actually 10 years in. And so left the board at that time. But during that 10 years, I started doing some personal investing in the space. Meanwhile, our private equity company ended up not doing much more in the space for a variety of reasons, some of which we just talked about, that it just was the wrong fit for the type of capital we had. But, in 2016, a company that we had co-founded together sold. And then in 2017, I took all of these smaller investments I'd made, rolled them into Rio Chato investments, and then, kind of created a thesis of how I wanted to move forward in investing in the space. And obviously that has evolved a lot over time, but that was really the genesis of all that.
I know you talk to a lot of founders every year, just like typical investors. You hear a lot of pitches, but you actually move on very few of them. And so I'm curious what separates the ones you say yes to from the good product, good pitch founders. who still get a no?
Yeah, I mean, I think it's the ones, I like to push on a lot of these business plans because, right, I mean, a pitch is a pitch is a pitch. It's I can put one together in an afternoon. It's really pressure testing that pitch and the either the entrepreneur or the management team that's put it together. Like I said, I like when they argue with me and not in a defensive way, but where they can really stake out and say, no, we know this because we've done the research. We know this because this is the feedback we're getting from our customers or our wholesale accounts. I think the good pitch founders explain why I'm wrong in whatever issues I'm having. The investable founders usually make me wonder if I'm wrong. I got one side telling me I'm wrong. The other side has convinced me that I need to go back and reread it and wrap my head around whatever this particular issue is. Also, I look for entrepreneurs that have already solved problems that they have no business have solved already. I mean, I talked to a founder the other day, and she's come out with a new line of ski helmets. She did it in 6 months from brand conception through launch, which number one is amazing. And the more I talk to her, the more I figure out how she's done it because she's extremely bright. But the other signal that has been really fascinating is that all these accounts started calling her and saying, hey, we need these in our store, and not little accounts, like, big accounts in Colorado, the main, like the Christie Sports and these bigger companies, they are looking at her product, seeing white space on their own wall, and then literally white space because all helmets either black or white. It seems like she's come up with a very colorful, cool design, and it pops on the wall. Those kind of signals when you're getting press without hiring a PR agency, or you're getting into these accounts without having a rep force, that to me is a huge signal and one that I take really, really seriously. And the founders that usually get the no, it's either a timing issue, they're not ready, I'm not ready, or they've really done a good job optimizing for the pitch instead of optimizing for their business, if that makes sense. It's clean, it looks good on paper, but when I start really pushing on things, it tends to fall apart a bit. I'd say those are kind of the three things I would say.
What do you think again, kind of asking you for a generalization of it, is what do you think the things are when you do push back to these founders that get a no? Like, what are the areas where they need to tighten up, or where are the areas that they've missed the mark?
Yeah, I mean, some of it's product market fit. It's wanting in the worst way to believe their own thesis, even though we start to dig into the details and what they're telling me doesn't really pan out, doesn't make sense. I would say that's usually the biggest trap. And then just knowing, I mean, like I said earlier, a timing issue. Do you know your unit economics? Do you know who your customer is? And I'm not saying like, every outdoors person, or yes, people that ski. I'm saying, let's talk about who specifically, single males between 18 and 25 that skateboard and do this, and they're working in this field. I mean, get specific about it. And you may not be entirely right on the mark, right? But I know then you're actually thinking about a really, a very clear case of who your customer is.
Sure. Build out the ideal customer profile.
Yeah. And then, hey, listen, it may change. You may find that, as I always say, no good plan ever survives first contact with the enemy. The same thing is true in business, right? You can have the best pitch, the best business plan. And then, the first week your product's in REI, you're finding out that it's an entirely different customer base than you thought. But, if you're smart, you figure out why that is, and then you double down, right? You lead into that.
Yeah. Maybe following the same lines. I don't know. Let's see if this goes there. But I'm curious what founder trait you've learned matters more than the product and the pitch.
I'd say coachability, without a doubt. Just coachability, especially if you're an early entrepreneur, younger entrepreneur, or one who doesn't have a lot of business background, but is super passionate. I've been on the other side of that when a founder believes so much in their original thesis, no matter what the market is telling them, they will not make changes. And that is, it's a death knell for most small businesses.
How do you pick up on that? Like, how do you pick up on the coachability in those conversations? Like, what are you looking for to say, like, oh yeah, over time, if we need to pivot, this founder is going to be able to pivot?
No, I think some of it is just, I give them pushback in the first meetings, being like I was talking about, and, not adversarial pushback, just kind of honest pushback about, hey, have you thought about these things? I think a coachable entrepreneur or coachable founder, when you push back on stuff like that, they'll lean in. And I think on the other side, someone who's not that coachable immediately goes on the defensive and why I'm wrong. Sure. And it sounds like it's in conflict with what I said earlier above, that people are explained in the what I don't understand. That's fine. But if you're just like, you don't get it, buddy, to me, then, it's fine. It's probably not the right investment for me. And I'm probably not the right investor for you. And we move on down the road. But I find that the best ones are curious and are willing to admit what they don't know and are willing to lean in when I push back on something like, I don't think you understand your unit economics that well because of these reasons. Oh, tell me more. Like, how can I tighten that up in a way that is going to be helpful to you?
When a talented founder with a good product stalls out, what's usually the cause behind the stall?
It's usually cash timing and cash flow management. And it's interesting. One of your previous guests, Heather, who founded Heather's Choice, just ran a workshop for entrepreneurs yesterday. I think I saw on her Substack that was just that. It was like, hey, here's how I managed cash in my business. And I think she coached him through some stuff and then actually gave him the tool. That kind of stuff is amazing because that's usually where these things fall down. It's not in the macro, right? It's in little things, timing. Like they've had a great year, but they kind of loosened up on expenses. They hit a seasonal trough. So they're not insolvent. They're just illiquid. They just don't have cash. They might be inventory heavy, but no money for payroll. And that's usually where I find people get stuck. Now, the people that have thought that through early on, and I usually try to help people think that through, they usually can weather that storm. But, cash timing is a problem. The other one is I kind of call it the confidence trap. They have a really successful launch and they're like, oh yeah, man, I am the golden child. I can do no wrong. And, they stop doing all the things that help them get there, the emails, the calls, all the little PR things, and they're hoping to kind of ride the wave because they're tired. And I get it. I mean, it's hard to start a company. And they're hoping that momentum would take them through. And it doesn't. And then I think the third thing, a little harder to name it, the company is just too big for them to run it the way they've been running it. And they continue to try to do it either themselves or with a skeleton crew. They don't know how to make that switch over from kind of the scrappy, entrepreneurial founder to an actual operator, if that makes sense. They're really good on the initial push. But, a lot of folks too, I find who are entrepreneurs, we get bored with the operations, right? We're great with starting things, right? But the day-to-day is boring. So, what I always tell people is, find your weakest trait and hire around it. Because that is going to save your business. My last business, I had an amazing partner who was an operator. Amazing operator. And he would run circles around me operating that business, partially because I would get bored, which is why I'm in the deal business, because I get to talk to new people every day and hear new pitches and meet new people. And that kind of fills my cup. For him, it was just operational excellence. And if he wouldn't have been there, we would have been not nearly successful as we were.
It's really interesting because there is this, the 0 to 1 entrepreneur is very different from the 1 to 10 entrepreneur.
Yeah.
You know what I mean? It's really it's a very different mindset. It's a different skill set. It's a different, almost like enjoyment level. some people love to watch things go from 0 to 1 and then they lose interest. And
Yeah.
then some people love to step in at 1 and be like, okay, cool. I like to make squiggly lines straighter.
Yeah. Right. And no. And then you have people, who are going to bring that company from 10 to 50, and it's a different skill set again. Now, I'm not saying that entrepreneurs cannot make those transitions, but it takes some intentionality. It takes being intentional about
Sure.
what are you trying to do? What do you need to learn? And more than anything, it takes humility and just being very honest with yourself and others about where your skill set is and what you need to brush up on.
Yeah. Like you said, who you're hiring, who you're bringing on the team to help you
Yeah.
and recognize it. So
Yeah.
that's why I always say self-awareness is the most important skill that an entrepreneur can learn.
Oh, absolutely. No. And listen, having been on the other side, right? I mean, it also takes a pretty healthy ego to start a business, if I've got to be honest. And sometimes it's hard to get out of your own way. And I was just as guilty early on as well, right? I knew what I knew, and it's taken me a long time to learn some of that humility that I wish I would have known early on. But again, I think, if I can coach an entrepreneur now and say, hey, I was in your same position. Here's the mistakes I made. This was the result. This is what I wish I would have known then. I'm going to give it to you for free, and you can get somebody that'll take that on board. That's great. Right. And that's what, being a mentor is all about. Let's help shortcut, this person's journey from, day 1 to year 20 in an afternoon, instead of having to spend 20 years of making mistakes like I got to do.
Wow. You can get from day 1 to year 20 in an afternoon. That's really effective.
Well, probably not, but I can at least tell them some pretty ugly stories about mistakes I made.
Sure. Okay. So we've touched on that probably leads us to a really good question about that dream that most outdoor entrepreneurs have, is that PO, those big POs from REI.
Yeah.
Right. And it's just like, oh, if I could just get into REI or, name the other big box retailer that with 1 or 2 nice meetings can really, really change the top line.
Yeah.
But what happens to those smaller brands, or what could potentially happen to those smaller brands once that dream comes true for them?
Yeah. And this is something that I've written about pretty extensively. And this is how I ended up starting my Substack, honestly, because this was a PDF I had created based on what I kept seeing over and over in the market. And I would send it to entrepreneurs and say, if you're going to work with REI, just think these things through. First of all, let me just be on record. REI, I think, is an amazing partner. Don't get me wrong. But, sitting in the entrepreneur seat, I get it. The order comes in, it's real. It's kind of everything they've ever wanted. But then the clock starts, and REI is paying in 60, 90 days. The brand needs to produce the goods, usually overseas. They're going to have to come up with a deposit. They don't really have the working capital to fund the production. And that's usually the first oh shit moment, right? It's like, oh, we have a $200,000 PO from REI, but we need $100,000 to pay for it, and we don't have $100,000. So they start scrambling. They're matching out credit cards. They're calling people like me, friends, family, to try to cobble that together. But or maybe they don't have that money to fund the production. So so they start making choices, right? They may delay production a while. They take less margin from the supplier. They put everything on a personal credit card. And then, if they get through the fulfillment, if they deliver, REI scans all into their system. And then, and this is the part that I think not a lot of people prepare for, REI has a really high performance expectations on sell-through. And that, again, that doesn't make them bad. They just need to be honest with people up front about it. If your product doesn't move in the first season, they're a lot of times, if you look at the contract that you've signed with them, they have the right to return it to you. So all of a sudden, this big order that was supposed to either save your company or launch it into the stratosphere, now you owe REI money on it, essentially. And that's a problem. I think that brands that survive that first big REI order, I kind of treat as an operational test, not as the sales victory. That makes sense. The ones who don't make it are a lot of times are out of business within 12 to 18 months, wondering what happened. So what I tell people up front is, and we're using REI kind of as is wholesale writ large, right? It could be Target, it could be Home Depot, Ace Hardware. It depends.
I mean, this happens all the time with Walmart, right?
Yes,
People,
100%.
they're so excited to get their salsa in Walmart, and then all of a sudden they're out of business in 18 months.
Exactly. And what I tell people is the best way to get around this is to plan for it, plan for the success, plan for having to come up with money. If that's in if this is your dream, figure out where that money's coming from before you get the order from REI. And then figure out how you're going to deliver it, figure out how you're going to help them merchandise, figure all that stuff out, because without that, you're kind of launching this product into the void, hoping, some green vest folks who are lovely people are going to figure out how to sell your product. And, it doesn't always work that way. It's funny that after I posted this on Substack, I got calls from two separate ex-REI buyers saying, oh man. And I was a little nervous to talk to them because I was like, uh-oh. I stirred up a hornet's nest, but they said, no, I saw this happen all the time. People leveraged everything to get in the store and it didn't work out. And they were kind of left holding the bag. And, they said, we wish we would have found better ways to manage that process. How, from REI's standpoint, how can we help you be successful as a vendor to us? So.
Yeah. And I know that REI is doing that, and other big box retailers do that with more regional launches or kind of more local campaigns, as opposed to getting you into all the doors. They will test you first, which is, from the brand side, it sometimes feels like a barrier. And what I try to remind people is like, no. This is what you should be pitching.
Yes.
You should be pitching a test.
Let's go into 4 stores, let's do the flagship store in Seattle and Denver and a couple other regional stores. Let's see how it goes. So you're not overextended. The other thing that happens quite frequently is you'll see a company that's doing really well in direct to consumer divert all their direct to consumer product to REI because it's such a big win, and they don't have the money to get the product. Well, now your DTC channel is completely dry. The product may just sit in on the shelves at REI, and meanwhile you have people clamoring for it. They can't get it because you don't have any product to ship from your 3PL. And that's another problem I've seen is just be aware of where your business is, where your customer is buying. Meet them where they are and where they want to buy from you.
Yeah. I mean, I think that's what Wes Allen said to me on a conversation on this podcast, is basically like that you want to be available wherever your customer is, mm-hmm. and that's okay, right? But you also want to be able to sell and maintain the right price wherever your customer is.
Correct.
And that's where the trouble
well,
comes.
And I think, I think just a quick point on that. I think a lot of people say, oh, well, direct to consumer is where it's at, right? Because obviously you have more margin, and what they don't factor in, and this is why I do love working with, I do like to have companies I work with wholesalers, is that especially in apparel or anything you got to try on, what people have started to do now on direct to consumer, they'll buy 3 sizes, they'll keep one and send 2 back, or they get it in, they look at it, I don't like the color, they send it back. Or, you're getting the calls at 10 o'clock at night saying, hey, this thing didn't work the way I wanted it to. And people don't really think about, like, you are, in the case where you're giving up margin to a wholesale provider, you're essentially paying that wholesaler to handle all of that for you. And, I think that's you may find that the margin at the end of the day, when all the costs are added in, are a lot closer than you think between the two. Unless you have you have a product that doesn't require any of that, and then it's a no-brainer. Nobody's going to send it back. I think that is a real risk that people don't think about.
We've talked a little bit about how early stage founders are funding their businesses, whether it's second mortgage or personal line of credit, credit cards, friends and family. Like, what other capital is out there that founders don't realize is available to them?
Yeah, I mean, I think I alluded to this earlier, but I think PO financing is a really big one, especially if you're a hard goods or soft goods manufacturer, creating physical product in this space. It's probably the single most underutilized tool. Like I said, I think a lot of founders go into this thinking that the only money is selling equity. But I mean, if you got a confirmed PO from a legitimate wholesale account, there's a lot of folks, including Rio Chato Investments, that will fund POs. And it's fairly low risk for us if it's an REI or someone like that. And is a really good way to take care of that problem that I was talking about earlier. This isn't an equity problem. This is just the working capital issue.
So
Go ahead.
I was just going to ask for people who have never heard of PO financing, just walk me through what PO financing looks like.
Sure. So let's say we'll go back to the venerable REI, because that's how I got involved in PO financing. I had one of the companies I invested in, they called me and said, oh my God, we have a $250,000 order from REI, but we have no way to fulfill it. And I said, well, send a scan of this thing over to me. I looked at it, completely legit. And I said, well, what if I just, we just loan you the money at, it's not it's usually in the high teens rate, but if you think about it, I loaned them the money at that first time for 90 days. And, they basically assigned the PO in this case over to me when they got paid. When REI went to make the payment came to me, I paid them, everybody was happy. And then, they started to build up their own working capital reserves. And, we did that a few more times, and now they're pretty much just doing these all on their own out of available cash. But it's a really good way to try, kind of get that flywheel going, so that they can start to do this on their own. But there are a lot of sources out there that look at things like this. Some of them, you just have to be ready for what. Some of them will, for example, take especially direct-to-consumer businesses will connect right into your Shopify account, and essentially every time you sell a product, they take their cut out of it. And some use Plaid to go right into your bank account and get paid. They pay themselves out of it. Again, nothing wrong with that as long as you go in clear-eyed about what you're getting into. And not everybody does, but it's not necessarily the cheapest way to go about things, but it's a lot cheaper than selling equity, especially early in a company where your equity is not worth that much.
Right. Are there times when you're like, don't do the PO financing? Are there any clear indications you're like, this is not the right fit for you?
Yeah. I mean, sometimes, it's more of, I'm looking at it going, hey, are you sure that this business that you're selling to is solvent? It's not, right. It's not a backcountry. It's not an REI. It's, I don't know, because some of these kind of more fly by night operations, and sure, they've put in a huge PO, and, I just don't feel comfortable with it. But, the other stuff you can do is like, which I was alluding to, is kind of revenue-based financing. So if you're doing, you've got consistent monthly revenue, and you want to capital invest, for example, in inventory or marketing, you can do those kind of the kick furthers of the world, which those are the ones I alluded to. They'll connect to your bank account in Plaid. It lowers their risk profile, so they're able to give you a better credit terms. But those are another option. And then there's community development financial institutions. So those are more usually kind of state aligned, but they exist specifically for businesses that can't access traditional capital. So I would also say, look at your state resources or provincial resources if you're in Canada. But, there's a lot, like in our state, we have a full Office of Outdoor Rec run by this great guy named Connor Hall, who is, advocates for the outdoor industry here. There's a number of loans, grants, and other things available to businesses. I actually just wrote a whole Substack thing about this because I didn't know about most of them, and most of my investments had no idea that these were available. But those are pretty cool too. You can really tap into some real money. It takes a little bit more time. There's a lot of legalese and bureaucratic stuff to kind of work through, but it's real money, and it's, the state's there to help drive economic growth in the state, or we even have it in our little valley in the Yapa Valley. We have a kind of a group that focuses on us as well. And then probably the last one I talked about is kind of the friends and family. I alluded to that earlier, especially if you're, early, getting friends and family money is probably one of the easiest ways. Post your leveraging your credit cards, borrowing from your 401k or whatnot, that most people get money to get started.
When you're talking friends and family, are you talking debt or equity?
It could be either or both. I've seen both. Usually, it's a little bit of equity, or somebody will do a convertible note. So it kind of behaves like debt until they get some other investment, and then the lender, mom and dad or whoever, Uncle Joe, can decide if they want to convert that into equity or not. But those are, that's the friendliest and that's the easiest to raise. It might lead to some uncomfortable Thanksgiving conversations if you're not able to pay it back. But,
Sure.
but it's, by and large, especially if someone's kind of more starting out in more kind of the lifestyle space, that's, I see friends and family in, I would say 100% of the deals I've ever done, where there's friends and family in the cap table somewhere.
For sure. I'm going to go back to the lenders who kind of attached to your Shopify store, for instance. I mean, Shopify itself has
loans.
What do they call it?
Yeah.
Shopify lending capital, something like that. Like you basically Shopify will loan you money.
Yeah.
Essentially.
And they do the same thing. Yeah. It's they basically saw these other revenue-based lenders doing this and said, well, hell, we want in on this. I mean, we're right here.
Right.
So they started doing the same thing. And, like I said, I think it could be a heck of a tool as long as you have very clear, predictable, growing cash flow. But you read the documents very carefully.
Perfect.
Here's
my warning.
Very carefully.
So I know a brand who is direct to consumer trying to grow their wholesale business, went and had a solid line of credit, took on, because they were trying to grow the wholesale business as well, took on a little extra capital through Shopify Capital, went back to the bank reviewed the business, looked at and saw, oh, wait a minute, you have this Shopify agreement on capital. That actually goes against the previous agreement that you had with the bank on this line of credit. Mm-hmm. We are closing your line of credit. And that's all of a sudden that $250,000 line of credit evaporated like the next day.
Yes.
And them taking whatever it was, $10,000 or $15,000 Shopify capital destroyed the $250,000 from the bank because they did not read the documents. So all these things are great. Please, please, please make sure you read the fine print.
Yeah, no, 100%. And no, if you've taken money, or an SBA loan is another, sometimes you'll take these SBA loans and then you're trying to borrow money from someone else. And I'll look, I look at all those documents and say, hey, did you realize that there's a covenant in here that you can't take on any additional debt? I get this blank look like, oh no. And I would say to everyone out there right now, run, the tools are available. Run these things through AI, and in about 5 minutes, you can find every gotcha in these contracts. This is not, not something you need to hire a $10,000 attorney for. You just, at least get the basics, know what you're getting into, because it can really trip you up. But again, for the right company at the right time, it's also can be a very good tool.
Oh, heck yeah. Heck yeah. Okay. So what happens, and I'm sure you've seen it before, what happens when the founder-investor relationship goes south?
I mean, there's a couple of scenarios, and it can go both ways, right? It can go both ways. You've got the entrepreneur can go south, and a lot of times the investor can go south. I think the worst one for me is when the founder just goes quiet. You've been getting all these great updates, and then all of a sudden it's crickets. The business is struggling. They're embarrassed. They stop returning your calls because they don't want to talk to you about it, right? They don't want to have the hard conversation. And I get that emotionally, but in these cases, the information is the one thing that I need to be useful, and that may be able to help get them out of whatever situation they're in. So when a founder, kind of disappears, it's just made a bad situation worse. The best version of that I see it as like a founder called me and said, "Hey, we're burning through cash way faster than we thought. You know, we probably only have 3 months of runway left. I don't want to make this call to you, but I need to talk to you about through. I need you to talk me through this. Like, what do I do?" And that was a great call, right? Because we sat down and whiteboarded and said, "Okay, well, you know, if this is this and this is, you know, maybe we can move some things around." And, you know, we found a way to get through it. But, you know, it's a hard call to make. It's a really hard call to make when you're like, I might lose all your money. But because they made it early, when they first saw the signals of things going wrong, we were able to solve the problem. Now, that's great. The other side of this is when an investor like myself, you know, is slow to have those hard conversations. I mean, I'm not dumb. I see the trends. I'm getting the financials. I know that things aren't going well. And this, I would say this happened more earlier. You know, we've been around for 10 years now, earlier in our investment cycle. You know, as I would look at it, but I love the founder. He's great. He's working so hard. This is going to self-correct. And, you know, that's a failure of the founder or of the investor, not the founder. You know, the relationship works both ways, and it works best when you're just having those direct conversations early and often, and just clearing the air. And, you know, if I'm worried about something, I should let them know. If they're worried about something, let me know, and we can find a way to get through it.
I heard an investor the other day say that I can take and handle any bad news you bring. I just can't handle surprises.
Yes.
And I thought that was a really good way of phrasing
100%.
it. It's like, let's have the hard conversation as early as possible, because the surprises don't help anybody.
Yeah, no, I mean, I had a similar, you know, call. You know, the one that we worked out, that was great. I had another one that said, "Hey, we got 3 months of burn left. And by the way, the bank that we borrowed all this money from, saying if we don't pay them back, they're going to close us down." And, you know, we all scrambled to figure out a way to handle it. But eventually the company shut down, and it was sad. But, you know, I would work with those entrepreneurs again. You know, we all made mistakes going into that one. But they were completely above board, and very open and honest with me. And that's what I look for. It's, you know, listen, maybe the first time didn't work. Second time's the charm. Who knows?
Yeah. You alluded to it a little bit earlier, and I want to hear you talk a little bit more about this idea of too big to be small and too small to be big.
Yeah. I call that the danger zone, right? Where, and we did allude to that earlier. So, you know, in the beginning, your passion can drive the company a long way. I mean, just pure grit and passion. I've seen that, and a good, you know, side order, a hustle, you know, get companies a long way. But at some point, when you start to have the complexities of the DTC, your 3PL, you know, a rep network, various wholesale accounts, you know, that starts to break down. You know, your passion and grit and personality can't do everything. So, you know, at a $500,000 top line business, you can run it yourself. You start getting up to $2, $3, $4 million. $5 million. You need a team. You need somebody handling ops. You know, you need structure. You probably need a CFO of some kind, whether that's, you know, fractional, or, you know, somebody that you've hired. You know, the problem is that most brands in this space, for a lot of brands in this space, hit about $1.5 million to $2.5 million in sales and get stuck. And it isn't because the product isn't good. The products are great. It's because the founder built a really, really efficient machine for running a small company, and they're trying to use that same playbook on a $5 million company, and it just doesn't work. Yeah, it's also the hardest place to finance as well, because you've kind of outrun the coverage of you know, small angels, friends and family, and you haven't quite gotten to institutional yet. So you're in this nowhere land. In the tech world, we used to call it the chasm. Like, how do you cross the chasm? Like, how do you get from, you know, there's just these natural inflection points in business. And I find in the outdoor space, it's usually $1.5 million to 2 million. And getting to that, you know, if you could jump that, then you're at 5, and things get a little bit better till you get to 10. But, you know, you've got these periods where you're kind of a tweener. You're not quite institutional. You're not quite friends and family. And that's why, that's why there's a lot of danger in that.
What are the few things that you've seen help people bridge over the chasm in those situations?
Usually they find some kind of partner, whether that's, a strategic investor, an operator, like a mentor on the operation side, or experienced hire who's done this before. Like, that's why I love the valley we're in here. We have this thing called garage beers where, you get all these folks in the outdoor industry together, literally in someone's garage having a beer. And you're really able to pick brains of some pretty amazing operators, who've done this, who worked for Smart Wool, worked for VF Corporation and been at Big Agnes 20 years. And then you're coming up with your new brand and you run into these problems and, you can get some real good, honest feedback. I think it helped a lot from what I hear around the tariff situation. We have like 27, or I think the last count, 27 or 30 outdoor brands in steamboat sprays, which is crazy to me. But, some of them are really small and some are quite large. We also birthed Smart Wool. We birthed BOA out of this little valley. And a lot of those folks, when those companies sold, stayed here and started new businesses. So we have quite a rich ecosystem here. But, finding those types of mentors is like gold, honestly.
Yeah, for sure. Ask for help.
Ask for help, 100%.
How much runway does an outdoor brand actually need to find its footing versus how much a founder plans for?
And most founders in this space, when I see them coming to me, usually they've got, we're kind of a pre-seed or seed round funding. So they've been at it a little bit, but even those guys are coming to me with a 12-month plan. And I think, 3 years in this business, you should at least on paper have thought out 3 years. It's not hyperbole. I mean, the industry has real seasonality problems. It's got long retailer lead times, long product development cycles. I mean, there are a lot of places to get caught out here. And like we said, a lot of this is a cash timing issue. It's not you're a bad person, you're operating a bad business, you have a bad product. It's just, there's a lot of moving parts and a lot of timing issues in this business. The founders that I worry about are the ones that raise exactly enough money to kind of prove their product market fit, but don't have any money to take that and move forward into a viable business. I'd rather see somebody take a little bit more upfront, at least to plan out for those 3 years, or at least know where that's coming from. I'm not at all saying, hey, take a ton of money up front either, because it's another trade-off, right? You're selling equity at a probably the lowest point it's ever going to be in your business. But at least, again, be clear-eyed about it, right? Have a plan, at least on a spreadsheet that says this money is going to get us through 3 years. It may not, but at least you've thought it through.
I believe it was Georgia Grace Edwards from NARA who was on this podcast a while back and said, raise enough money so that you can stop fundraising.
Yeah. No, I mean, it's funny. I talked to Georgia Grace. I think she was right out of college when I first talked to her, and there was still Sheepfly. And she's great, by the way. She's amazing. And what they've built is very cool. But I tell people that all the time. Like, half the people that I see at these pitch competitions and things that, there's seems to be more and more of them in these accelerators and all this. They're spending 80% of their time raising money and 20% of their time running their business, and it should be the other way around. Or like I said, like she said, raise enough that you can take time and focus on your business, because that's, eventually I've seen fundraising kill a business, right? They're just chasing their own tail. And it's scary, but yeah, that's good. And people should listen to her. She's smart.
You talked about it at the very beginning of this conversation about what sets kind of the outdoor industry apart is that we have really solid lifetime value in our customers, and we're building community.
Mm-hmm.
And it's once you've got your customer kind of bought into that community and bought into that brand, then you can continue to sell them new products, which could be actually challenging because, a lot of times garage-based founders have got this one killer
Yeah,
idea, and then they build this community, and they're like, oh, I need to keep selling them more if I'm gonna. Yes, I can expand,
yeah.
but I can also be, using that advantage that I already have people in the community. How does a brand successfully grow into those new product categories?
It's a good question. And it really depends on the founder. I mean, there's a whole, I mean, garage ground gear, right? Lloyd Vogel's deal exists for a reason because there are so many, like you said, of these cottage outdoor industry products. And they may all be optimizing for different things. They may be optimizing for lifestyle. They may be optimizing for location. They may be optimizing for being able to spend time with their kids when they're little. And they may not be optimizing for maximum cash flow, right? Or maximum exit value. And you know what? God bless them, more power to them. I think that's great. Um, but the ones that do want to grow within those communities, I mean, my biggest is piece of advice is ask your community what they want. Ask your community what, what they trust you to build for them. What do you have license to do? As long as you know, one of the things you do when you create these communities, you kind of create this brand promise. And as long as you're backing that up again and again, whether it's through your products or whether it's through your service or whether it's through your, community building efforts, these people are going to keep coming back to you. And I have no problem going out to my own community and say, hey, what about this? I mean, more and more, I kind of was talking to someone the other day and I came up, kind of was tossing this thesis around that I think this next wave of outdoor companies is going to look a lot less like a product company and more like a community with products attached, if that makes sense. And the more we're seeing all this artificial AI, focused on the attention economy. But I mean, if you can make 1,000 very similar ads for Instagram with a push of a button, are people going to look at those things anymore? Or are they going to, or are they looking at community? And I think, more and more people need to think about how are they going about intentionally cultivating their community, keeping it healthy. And yeah, I think that's a two-way street. I think, giving a product and then getting information back about, hey, how can we widen our footprint within your life, in the best way possible.
Yeah. Build 1,000 true fans.
Absolutely.
Where do you think the real white space is for the independent brands, the small brands right now in the outdoor industry?
I think about this a lot because obviously I see a lot of pitches where everyone says, I mean, and that's a big buzzword right now, the white space. I think I was talking to somebody the other day and I'm like, where companies have gotten bloated and lazy and just have stopped caring about that feedback loop with the customer is a great spot to focus and take market share. And, I see it kind of across the board. You've seen a lot of companies restructure their, these owners of brands like VF, either peel off brands like Eagle Creek, for example, which is run just down the street here now, or try to retool brands like Vans because they lost $2 billion in market share. I mean, dropping $2 million on the floor, that's a pretty big banquet for small companies to say, hey, I think I can earn some of that market share back for me. And, I would look at those types of situations. On the fly fishing side, Sims recently had a bit of a debacle when they got bought out by Vista a few years back. And then, I think there was, what went from a very community centric approach to a very kind of venture capital PE focus to their customers, which are generally fly shops, cause a lot of problems and are very widely known and reported on. But you saw people like Squala, for example, come and eat their lunch. And, they're not nearly as big today, but Squala, I looked at some numbers the other day that, their growth in some of these markets is astronomical and good for them. But that, those are the places where I just think that people have broken down on that brand promise, is an opportunity for somebody to go into that community and say, hey, give us a shot, give us a shot. We've got something new, novel, or, just backed by a lot more service and focus on the customer than this, this other, $20 million, 30, 40 million, billion-dollar company out there.
Sure. That's one thing that keeps coming up again and again is that, and we talk about it lots, is that the outdoor industry is now full of publicly traded companies, venture-backed companies, private equity-owned roll-ups. And to me, that's just a really great opportunity for founder-led brands to plant their flag and be the voice of for the communities. Like, you have these characters. Well, I mean, Lloyd from Garage Grown is a great example. Dan Durston from Durston is a great example. We've got, there's all sorts of different brands out there that are the founder is the voice in a lot of ways, like Georgia Grace and at Nara. There's all sorts of different. It's like use that as your advantage,
Yes.
right? That you can actually you can build in public. You can be the face of the company, and people are going to align, and that's where you can differentiate. Where the other people can't.
I just wrote this piece for there's a online fly fishing magazine called Fly Lab out there. Great source for people interested in fly fishing. But I just wrote something that kind of was about this, right? With AI coming in, people are going to, it's already happening. People are looking for physical experiences. And I think that the brands out there that can help curate those and own those particular species, whether it's fly fishing or it's running or it's rock climbing or whatever, if you can get in and own a lane in there, I think you can really jump ahead of the competition.
Cool. Well, we're going to wind this thing down. I've got a couple of last questions for you.
Sure.
What's one thing that every founder should internalize before they take their first dollar of investment?
You're not raising capital. You're choosing a partner for the next 5 to 10 years. And I think that there are far too few founders who've really thought about that. You're giving this partner structural rights over your business. They're really hard to undo once they're in place. So just make sure you're getting into business with someone that you trust. I think the urgency around the fundraise makes it feel very transactional, but it's not. I mean, it's very relationship driven. Those relationships are either going to make and break you during your hardest moments. Kind of what we were just talking about earlier. Is this someone that you feel you call and say, oh shit, we see this train coming down the tracks, help us out? Or is it someone that you're afraid to call because, they've given you nothing but bad attitude since you signed the documents? The one thing I tell founders all the time is they never seem to reference check their investors, right? I'm always reference checking. I ask for references all the time if I'm going to invest in somebody. And that may be, Uncle Joe again, because they haven't had a lot of track record yet. But I don't think, maybe one or two folks has actually asked me, hey, is there somebody I can talk to that things went well with? Hey, is there a founder I can talk to where things didn't go well? And because I want to know how you're going to react. Because by the way, both of those things are going to happen. It's not like might happen, right? You always have a few really great things happen and you're going to have one reaction, and then you have some bad things that happen. It happens every time. I've never, had anything that's just been smooth sailing. And you'll ask, how did they react? And if your investor is unwilling to give you those names, that's the answer right there. That tells you a whole hell of a lot about that investor.
That's a good point. I appreciate that. The question I always end with is, how do you define success for yourself?
That's something that I have been bouncing around for a long time. And I think where I've landed is optionality, right? Not wealth, not a number, optionality. I want to have enough security that I'm able to do the things I want to do with the people I want to do them with and not do the things I don't want to do. And to me, it boils down. I mean, it's that simple. I don't need I don't need the country club and everything else, but I do need to be able to get out on a Friday afternoon and go ride my mountain bike for a couple hours. I need to be able to get up on a Tuesday morning and go down to the Yampa River and fish and clear my head. For me, those are the important things. Now, everybody's got their own definition of success, but, I think in my business, especially around investing, it's very easy to get lost in this definition or this version of success that is just wholly focused on, maximizing, returns, being invited to keynote speeches and, getting wined and dined. And yeah, it's not for me. And I just had to be like I say to other people, be clear-eyed about what you want. I had to be clear-eyed about it. And, that's why I'm in this industry, because I know to work with people I like, with, sports and products that I enjoy using in my day-to-day life. And, I, you asked me earlier, I only back a few companies. I would rather back one company that I can give everything to in terms of, myself, knowledge, support, than, 20 that are going to give me a great return. But, now I'm meeting out a little bit of help here and there. And, I'm all of a sudden I've chewed through all of my personal time. I book my personal time in my calendar, and I recommend people to do that. And not just like, I think I'll go mountain biking today. No, I say I'm going to go ride bus pass today or like Friday at 4:00. And then when somebody tries to book an appointment with me at Friday at 4, I say, I'm sorry, I have a conflict. I think, that's how jealously I guard my, my personal time, because it's important. I'm not able to do what I do if I don't do that. I'm not I'm not a good partner. I'm not a good dad. I'm not a good investor. I'm not a good anything. If I am not getting that time, in the things where I find joy. And so, I really recommend people that. But yeah, optionality by far for me is the most important, success for me.
It's great. I appreciate that. I like that word, optionality. It's a good one. Andrew, this has been great. I really appreciate it. I first found out about you through Substack, so I will link to your Substack, because I highly recommend everybody subscribe to it, because you are spouting the wisdom on a regular basis, and I really appreciate it. Where else would you want to send people to connect with you, learn more about what you're up to?
Yeah, you can go to www.riochato. It's RIOCHATO.com if you want to find out more about the business. I always invite people to connect with me on LinkedIn as well, as long as it's relevant. If it makes sense for us to have a deeper conversation about a business idea you've got, a business that you've put together, or anything else around this, I'm usually pretty open to those conversations.
Thanks for your generosity, Andrew. We're all benefiting from it, and I appreciate it.
Well, thank you. Appreciate the time today.